All right, guys, I just want to do a quick tutorial on the deferred tax implications if there's a change in the CGT inclusion rate, just like that which happened this year. And as you know, our CGT inclusion rate went from 66.6% to 80%. All right, so consider the following little fact pattern. In my little example here, you will see I've got land. Right, and let's assume that the land had an original cost of 100,000 and it is being measured subsequently on the revaluation model, and to date revaluations of 50,000 have been recorded, giving us a carrying amount of 150,000 rand. Then I've also done a little investment property. We're going to assume that the investment property originally cost us 175,000, and its cumulative revaluations to date have been 75,000, giving a carrying amount of 250,000. Now, looking at the tax bases of those items, okay, the land, obviously, you always treat as if there's an intention to sell it, so the tax base would simply be the historical cost, or the base cost, if you like. That's what SARS would allow as a tax deduction if you sold the land. On the investment property, I've assumed there that this is an item of property, so it's a building, on which SARS will give an allowance. And I've just made the assumption here that the allowance is 10% per annum, and the asset is 2 years old. That is to say, 35,000 in wear and tear has been granted, which means a further 140,000 in wear and tear will be granted over the life of the asset. Right, so that gives us temporary differences of 50,000 on the land, and then obviously there is 35,000 on the historical cost element of the investment property, and a further 75,000 that has come about as a result of subsequent revaluations. Right, now, in providing for deferred tax, both land and investment property are treated as if there's an intention to sell it, which means that there could be potential CGT implications. The way I always present that is as follows. I basically have a deferred tax at normal rates column and a deferred tax at CGT rates column. Okay, so DTN stands for normal, DTC stands for CGT. And I think you'll agree that anything that is above cost, in the case of the land, it's the full temporary difference of 50,000 is going to be at CGT rates. And there I've used 66% inclusion rate at the corporate tax rate of 28%. All right. And then under the investment property, just bear in mind that everything up to cost, so the tax value up to historical cost, or your historical cost minus your tax value, is going to be recouped at 28%. All right. And only the element of the carrying amount that is above cost, if you sold it today, okay, would be at CGT rates. So in a nutshell then, if you sold the asset for 250 today, you would have a recoupment of 35, and then there'd be CGT on the amount above cost, 75,000. All right, now, all of this tax you see over here, this tax over here, has been provided for at the CGT rate, at an inclusion rate of 66.6%. So we've got 9324 and 13986, which is 23,310. Here we've got 9,800. Okay, that's a liability, and both of those are liabilities as well. Now, if you are told that in the current year there's been a change in the CGT inclusion rate from 66.6 up till 80, I think you'll agree that the CGT amount, this, has got to get bigger. This amount over here is going to remain unaffected. So your logic is exactly the same as any given change in tax rate. In other words, what we're going to do is we're going to think of it in journal entry terms. So first of all, I'm going to ask the question, what's happening to the inclusion rate or the tax rate? And in this case, the tax rate, you can all see, is going up by 13.4%. All right. Which means that my deferred tax liability needs to go up. So I'm going to have a credit here, credit DT SFP. And the other side of the entry could be your income tax expense in profit or loss, or it could be reval surplus in OCI, it could be mark to market in OCI, it could be any of those other comprehensive income type reserves. Okay, so the amount, first of all, is 23. We're going to take the amount of 23,310, and just like any change in rate, we're going to multiply it by the rate change, that's the increase of 13.4%, and divide it by the old rate, which is 66.6%, and that's going to give us the rand value of the effect of the change in tax rate, and that's the adjustment to SFP. So times 13.4 divided by 66.6 gives us 4690. Your liability is going up by 4690. Right. The other side of that entry, we're used to putting in profit or loss. But here we need to just be a little bit careful, because if we have a look at it, the amount of that deferred tax balance attributable to the land, you'll appreciate that that would have arisen through other comprehensive income. That is to say, when you revalued your land, and this land is property, plant, and equipment, the revaluation gain would have been presented in other comprehensive income. That is to say, the tax effect on that, the tax charge on that, would have been presented in other comprehensive income, and likewise, any subsequent rate change needs to be presented in other comprehensive income. So here we go then. Other comprehensive income, reval surplus, 9324 times 13.4 over 66.6. That amount which is 2814. Okay, the tax expense, or the tax charge, if you like, is going to be presented in other comprehensive income. And then you will appreciate that the remeasurement of investment property would have been presented in profit or loss. So 13,968 13,986, I beg your pardon. That multiplied by 13.4 over 66.6, which is going to give us that's going to give us 2814, and then I made a little typo mistake over here. Sorry, 9324 times 13.4 divided 666 is 1876, and those two together gives you 4690. Okay, so in other words, we treat it like a rate change. You take the deferred tax balance, but only that deferred tax balance that has been provided for at CGT rates. You multiply that by the change in the CGT rate over the old CGT inclusion rate. And that gives you the adjustment that you need to present in financial position. In this case, the rate is going up, so the liability must go up. All right. The other side of that entry depends on where the underlying item was, where the remeasurement of the underlying item was presented. To the extent it was presented in profit or loss, like investment property, that portion of your change in rate is going to be presented in profit or loss. To the extent that it was previously presented in other comprehensive income, well, that element of the remeasurement, the change in the rate, I beg your pardon, will be presented in other comprehensive income. Right, I hope that's helpful for tomorrow. I just thought last minute it was something I might consider, seeing as though there has been a change in the CGT inclusion rate this year. So they've got